when I talk about support and resistance, I'm not talking about some fancy theory cooked up in a back room by men who never risked $1 of their own money. I'm talking about the living, breathing habits of price, the same way a crowd of people will slow down at a doorway and bunch up before pushing through. Price does the same thing. It hesitates. It remembers. It leaves footprints. And if you learn to read those footprints, you stop guessing and start thinking like a man who wants to survive in this business. You've seen it yourself, haven't you? A market hits a certain level, backs off, then comes back to it again, like it's testing the water with its toe. Support is simply where buyers have shown up before. Resistance is where sellers have made their stand. But the real trick is not in memorizing those words. The trick is in understanding why those levels exist. They exist because traders remember pain and profit. A man who bought a stock at 50 and watched it fall to 40 remembers that level like a scar. When price climbs back to 50, what does he want to do? He wants out. He wants relief. So he sells, and that selling creates resistance. That's not a chart pattern. That's human nature written in numbers. You can't ignore that, can you? Now, when price falls to a level where it bounced off before, that's support. That's where buyers once said, "This is cheap enough." But you must never assume it will always hold. Support is not a concrete wall. It's more like a wooden fence. It holds until it doesn't, and when it breaks, it tends to break fast, because all those hopeful buyers suddenly become fearful sellers. Have you ever noticed how a stock drops faster than it rises? That's not an accident. That's emotion taking over. What most traders do wrong is they treat support and resistance like lines carved in stone. They draw a neat little line on their chart and think it's a guarantee. But the market doesn't care about your neat lines. It cares about pressure. How much buying is there? How much selling? Those levels are really zones, not exact prices. They're areas where the battle between buyers and sellers is likely to flare up again. And your job as a trader is not to predict who will win, but to wait until the winner shows himself. Isn't that what a smart businessman does? Wait for proof before he commits his money. You see, when price approaches resistance, you don't jump in just because it's there. You watch how it behaves. Does it stall? Does volume dry up? Does it start slipping back? That's the market telling you the sellers are still in control. But if price pushes through that resistance and holds above it, something important has changed. Those old sellers are gone, and new buyers are willing to pay higher prices. That's not a small thing. That's a shift in the balance of power. And when resistance becomes support, that's one of the clearest signals you'll ever get that a trend is trying to move forward. Have you ever watched a market break free like that and felt the air change? The same logic works on the downside. When support breaks, it often becomes resistance later. The people who bought there are now trapped. When price comes back up, they sell just to get their money back. That selling caps the rally. So you can see how these levels create a kind of memory in the market. It's like the market never forgets where people got hurt. And as a trader, you should never forget either. Now let me say something that took me years and a lot of lost money to learn. Support and resistance are not trading signals by themselves. They are context. They tell you where you are in the story. They don't tell you what the next chapter will be. Too many traders think that just because price is at support, it must go up. That's like thinking a man standing at a cliff must jump back instead of forward. He might, but he might also fall. You need more than hope. You need confirmation. That confirmation comes from how price behaves at those levels. Does it hold? Does it break? Does it retest? These are not academic questions. They're the difference between keeping your capital and donating it to the market, and capital is your lifeblood. Without it, you're not a trader. You're just a spectator with opinions. Isn't that a hard truth most people would rather avoid? A trader with the right mindset looks at support and resistance as places to manage risk. If you buy near support, you know exactly where you're wrong. If that level breaks, you're out. You don't argue with the market. You don't make excuses. You take the loss and wait for the next opportunity. That's how you stay in the game. and staying in the game is what allows wealth to build over time. Not by hitting home runs, but by avoiding strikeouts. When you sell near resistance, it's the same thing. You're not saying the stock can't go higher. You're saying the odds are better that it will hesitate or pull back here. And if it doesn't, you cover and move on. There is no shame in being wrong. The shame is in letting a small loss turn into a big one because you refuse to respect what the market was telling you. Have you ever noticed how the market is always honest, even when it's cruel? Another thing you must understand is that the more times a level is tested, the weaker it becomes. Every time support is hit, some of the buyers get used up. Every time resistance is hit, some of the sellers get used up. Eventually, one side runs out of ammunition. And when that happens, price moves. That's why a stock that keeps knocking on the same door often ends up going through it. The pressure builds, and then it releases. You don't need to predict when it will happen. You just need to recognize when it does. This is where patience comes in. A man who is in a hurry will trade every touch of support and resistance and get chopped to pieces. A man who waits for the break and the hold will catch the real moves. And the real moves are where the money is. Not in the noise, not in the little wiggles, but in the clean shifts of control from buyers to sellers and back again. Isn't that what you're really after when you sit down in front of a chart? When we say support is a buying zone, not a guaranteed floor, we're really talking about how uncertain the market always is, even when things look obvious. A lot of traders come into this business believing that if price hits a certain level, it must bounce. They draw a line across their chart, label it support, and then they feel safe buying there, almost like the market owes them a rally just because that level held before. But the market doesn't owe anyone anything. Support is not a promise. It's just an area where buying showed up in the past, and past behavior only gives you a clue, not a guarantee. Think about what actually creates support. It's not magic. It's people deciding, at that moment, that the price is attractive enough to buy. Maybe they think the stock is cheap. Maybe they think it's oversold. Maybe they just see others buying and don't want to miss out. Whatever the reason, that buying pushes price up and creates a bounce. Later, when price comes back to that area, traders remember it. They think, it bounced here before, so it should bounce again. That belief alone can create more buying, at least at first. But belief is fragile. It only lasts as long as it's reinforced by real orders hitting the market. This is why support is a zone. It's a range where buyers might show up, not a single price where they definitely will. One trader might be willing to buy at 100, another at 99.50, another at 98. Those orders spread out over a range create the appearance of a level. But if selling pressure is strong enough, it can chew through all of that buying like a tide, washing over a sandcastle. From the outside, it might look like support failed, but really it just ran out of willing buyers. The danger for most traders is that they confuse probability with certainty. Support increases the odds of a bounce, but it does not ensure one. If you treat it like a guarantee, you start holding losing trades longer than you should. You start telling yourself stories about how it has to turn around because it's at support. That's not analysis, that's hope. And hope is one of the most expensive habits a trader can have. When price approaches a support zone, the smart trader watches, not jumps. They look for signs that buyers are actually stepping in. Are the candles getting smaller? Is the selling slowing down? Is there a sharp rejection of lower prices? These little clues tell you whether the zone is still being defended. If you don't see that, you don't have support, you just have a number on a chart. And numbers don't trade, people do. Another thing people miss is that support can change character. A strong support zone that holds again and again can suddenly become weak if the broader market shifts or if new information comes out. Maybe earnings disappoint. Maybe the whole sector starts selling off. Suddenly, the buyers who used to defend that area step aside. They're no longer confident. And without confidence, support is just empty space waiting to be filled by selling. That's why you always have to see support in context, not in isolation. Support is also tied to time. A level that held a year ago might mean nothing today. The traders who bought there might have already sold. New traders have come in with new opinions. The longer ago a support level was formed, the less emotional weight it carries. Fresh levels, where recent buying happened, tend to matter more because the memories are still alive. People still remember their entries, their losses, their profits. Those memories drive action when price comes back. If you're using support as a place to buy, you have to think in terms of risk, not prediction. The whole point of buying near support is that you know where you're wrong. If price breaks cleanly below that zone, you don't argue, you exit. That small loss is the cost of doing business. It's like paying rent to stay in the trading game. What kills traders is not being wrong, but being stubbornly wrong. There's also a big difference between a shallow dip into support and a violent plunge. A gentle pullback suggests that sellers are losing energy and buyers might soon take over. A fast, heavy drop into support suggests panic, and panic doesn't usually stop just because of a line on a chart. In those moments, support often breaks, not because it was never real, but because fear is louder than logic. Support also behaves differently in trends. In an uptrend, support zones are often respected because the dominant pressure is buying. Pullbacks get bought, and the trend continues. In a downtrend, support is much more likely to fail because sellers are in control. Trying to buy support in a strong downtrend is like trying to catch a falling knife. It might work once, but eventually you're going to get cut. This is why experienced traders don't just ask, "Is price at support?" They ask, "What kind of market am I in? Is money flowing into this stock or out of it? Are institutions accumulating or distributing?" Support in a healthy market is a very different thing from support in a sick one. The zone might look the same on the chart, but the forces behind it are not. There's also the issue of false breaks. Sometimes price dips below support, triggers stop losses, and then quickly snaps back up. That doesn't mean support was fake. It means larger players used that area to shake out weak hands and build positions. This is another reason why support is a zone, not a single price. The market often probes below it to see how much selling is really there. When we say resistance is selling pressure, not a brick wall, we're stripping away one of the most dangerous illusions traders carry with them. A lot of people think of resistance as some solid ceiling, like price hits it and must fall. They draw a line, feel confident, and start selling just because price is up there. But the market is not a building with fixed floors and ceilings. It's a moving auction, and resistance is simply the area where sellers have decided, at least for now, that prices are high enough to let go of what they own. Every resistance zone is built out of human decisions. Traders who bought lower see profits and decide to lock them in. Traders who bought at higher prices and were stuck underwater finally get a chance to get out. New traders think the price looks expensive and start betting on a pullback. All of that selling creates a cluster of supply. That's what resistance really is. It's not a hard limit. It's a crowd of people pressing the sell button around the same prices. Because it's a crowd, it can be overwhelmed. If buying demand is strong enough, it will chew through that supply and keep going. That's why you can never assume resistance will hold. You have to watch how price behaves when it gets there. Is it stalling? Are candles getting smaller? Is volume dropping? Those are signs that sellers are gaining the upper hand. But if price keeps pushing, closing near the highs with steady or rising volume, that tells you buyers are not afraid of those sellers. They're willing to pay higher prices, and that's how resistance gets broken. A lot of traders get hurt because they treat resistance like a guarantee. They sell into it, feel smart when price pulls back a little, and then freeze when it keeps going. Instead of admitting they're wrong, they hold on, convinced that it has to turn here. That kind of thinking turns a small mistake into a big loss. The market doesn't know where your resistance line is, and it certainly doesn't care. Resistance is a zone for managing risk, not a signal to blindly bet against the trend. If you sell near resistance, you're not predicting that price will fall. You're saying that, at this point, the odds of a pause or pullback are higher, and if you're wrong, you'll get out quickly. That difference in mindset is everything. One is gambling, the other is trading. Just like with support, resistance is memory. People remember where they sold, where they missed selling, and where they got stuck. If a stock ran up to 50 and then collapsed, a lot of traders will be nervous when it comes back to 50. They don't want to relive that pain, so they sell, and that adds to resistance. But if the stock keeps pushing through 50 and holds above it, that old fear starts to fade. The sellers are gone, and new buyers take their place. That's when resistance becomes support, and that shift tells you something real has changed. The strength of a resistance zone also depends on how many times it has been tested. A level that has been hit once or twice may be strong, because there are still plenty of sellers left. But every time price comes back, some of those sellers get filled. Their orders are gone. Over time, the selling dries up. When that happens, the next push-through can be fast and powerful, because there's nothing left to hold it back. This is why you often see markets coil under resistance, making higher lows as they press against the same ceiling. Buyers are getting more aggressive. Sellers are getting used up. The tension builds, and eventually it snaps. Traders who understand that resistance is pressure, not a wall, are ready for that moment. They're not stubbornly shorting just because price is high. They're watching to see which side gives way. There's also the issue of fake breakouts. Sometimes price will poke above resistance, trigger buy orders, and then fall back. That doesn't mean resistance was meaningless. It means there was enough selling above that level to absorb the initial buying. The key is not the first break, but what happens after. Does price quickly drop back and stay below, or does it hold and try again? Resistance is a process, not a single event. In strong uptrends, resistance zones are often just speed bumps. Price might hesitate there, but the underlying demand is so strong that it keeps pushing higher. In weak markets, resistance can be brutal, stopping every rally and sending price back down. That's why you always have to look at the bigger picture. Are institutions buying? Is money flowing into this market? Resistance in a healthy trend is very different from resistance in a sick one. From a wealth building perspective, understanding resistance keeps you from fighting the tape. If you're always selling just because price looks high, you'll miss the big moves that actually build accounts. Big money is made by riding trends, not by picking tops. Resistance tells you where the market might slow down, not where it must stop. Using it properly means you take partial profits, tighten stops, or wait for confirmation, instead of blindly betting against momentum. It also teaches you humility. Every resistance break is a reminder that the market is bigger than your opinion. You might think something is overpriced, but if buyers keep paying up, that's the only truth that matters. The trader who respects that survives. The trader who argues with it doesn't. When you watch price approach a resistance zone, you should be asking yourself, are the sellers really in control here, or are they just trying to be? That question keeps you engaged with what's actually happening, instead of what you think should happen. It forces you to listen to the market instead of talking over it. When we say repeated tests weaken any price level, we're getting right to the heart of how markets actually move. A lot of traders think the more times a support or resistance level holds, the stronger it becomes forever. They see price bounce 3 or 4 times and assume it's now indestructible. But the truth is almost the opposite. Every test uses up orders. Every bounce or rejection consumes the traders who were willing to defend that level. Over time, that pool of buyers or sellers gets thinner, and when it's thin enough, the level finally gives way. Imagine a support zone where buyers step in and push price up. That first bounce happens because there were plenty of buy orders waiting there. When price comes back a second time, some of those same traders buy again, and some new ones join them. The level holds again. But after a few tests, many of those traders are already in. They've used their capital. They don't have unlimited money to keep defending the same area, so each time price returns, there are fewer fresh buyers left to absorb the selling. From the outside, it still looks like support, but on the inside, it's getting hollow. The same thing happens at resistance. The first time price hits a resistance zone, sellers are eager. They take profits, they short, they push price down. The second time they do it again. But after a few tests, many of those sellers have already sold. They don't have more inventory to dump. So when buyers show up again, there's less supply to stop them. Eventually, the buying pressure outweighs what little selling is left, and price breaks through. This is why you often see markets build up energy before a big move. They go back and forth between the same support and resistance, chewing through orders on both sides. It's like a tug of war where both teams are getting tired. When one side finally lets go, the rope snaps in the other direction. That snap is what traders call a breakout or a breakdown, but really it's just the result of one side running out of strength. A trader who understands this doesn't get comfortable just because a level has held before. They get cautious. They know that every test is another drain on that level's ability to hold. Instead of saying, "It bounced here 3 times, so it will bounce again," they say, "It's been tested 3 times, so it might be close to failing." That shift in thinking keeps you from getting blindsided when the market finally moves. This idea also helps explain why false breaks happen. Sometimes price will poke through a level, then snap back. That's because there were still enough orders left to defend it, even after all those tests. But every false break still uses up more of those orders. Each attempt weakens the line a little more. So if you see price attacking the same level over and over, you should be thinking about what happens when it finally doesn't bounce. There's also an emotional side to this. Traders who keep seeing a level hold start to feel safe. They pile in with bigger positions. They place their stops just below support or just above resistance. All of those stop orders become fuel for the next move. When the level finally breaks, those stops get triggered, adding to the momentum in that direction. What looked like a strong level becomes the launchpad for a fast move because of all the built-up positioning. This is why the most violent moves often come after long periods of sideways trading. Price is testing the same boundaries again and again, building tension. Traders get bored, they get confident, they get complacent. Then, when the break finally happens, it catches a lot of people on the wrong side. The move is not random. It's the release of all that stored up pressure. In terms of trading, this means you have to be very careful about buying or selling a level that has been tested many times. The reward might be smaller, and the risk might be bigger, because the odds of a break are higher. Sometimes the better trade is to wait for the level to fail, and then trade in the direction of the break. That's where the fresh momentum is, and that's often where the bigger moves begin. It also ties into your mindset. You have to be willing to change your opinion as the market evolves. Just because a level worked yesterday doesn't mean it will work today. Markets are not static. They're always adjusting as new traders enter and old ones exit. The more a level is used, the less useful it becomes. Holding on to old levels out of stubbornness is a good way to get stuck. Repeated tests also tell you something about intent. If price keeps coming back to a resistance zone, it means buyers are persistent. They're not giving up. That persistence is a clue. Likewise, if price keeps coming back to support, it means sellers are not done yet. They keep pushing. Those repeated pushes are information. They tell you which side is trying harder. A lot of traders focus only on the bounce or the rejection, but the real story is in the repetition. One bounce is just a bounce. 3 or 4 bounces are a campaign, and campaigns either succeed or fail. When you see a market repeatedly attacking a level, you're watching a campaign unfold in real time. This is where patience becomes an edge. Instead of trading every touch, you can wait and see how the battle develops. Are the bounces getting weaker? Are the pullbacks getting shallower? Those subtle changes tell you when a level is about to give way. You don't need to predict it. You just need to be ready when it happens. When we say breakouts change the balance of power, we're talking about one of the most important moments in any market. Most of the time, price is stuck in a kind of tug of war between buyers and sellers. It moves back and forth, finding support, hitting resistance, and staying inside a range. Neither side is strong enough to take full control. But a breakout is the moment when that changes. It's when one side finally overpowers the other and forces price into new territory. Before a breakout, both sides are active. Sellers feel confident near resistance. Buyers feel confident near support. Trades go back and forth, and nothing really changes. But as price keeps testing the same levels, something starts to shift. One side begins to lose strength. Orders get filled. Capital gets used up. Confidence starts to fade. Then, when price finally pushes beyond that boundary and holds, the old balance is gone. A new one takes its place. This shift is not just technical, it's psychological. Traders who were comfortable inside the range suddenly have to make decisions. If price breaks above resistance, short sellers are in trouble. They start covering their positions. Traders who were waiting for a pullback realize it might not come. They jump in. That new wave of buying pushes price even higher. What started as a small break becomes a move with momentum behind it. The same thing happens on the downside. When support breaks, long traders feel trapped. They sell to get out. Short sellers feel validated and press their bets. Buyers who were waiting for a bounce step aside. The selling feeds on itself. The market is no longer balanced. It's tilted, and it moves quickly in the direction of that tilt. A lot of people think breakouts are about lines on a chart. They're not. They're about people changing their minds. A resistance level represents a place where sellers once felt in control. When price breaks through it, those sellers are no longer in control. They either leave or get forced out. That vacuum is what allows price to move. Without that shift in behavior, there is no real breakout, just noise. This is why the best breakouts are the ones that hold. Price pushes through a level and doesn't immediately fall back. That tells you the new side really has the power. Buyers are willing to defend higher prices. Sellers are no longer confident enough to push it back down. That's the kind of environment where trends are born. From a trader's perspective, this is where opportunity lives. Inside a range, the moves are limited. Price goes up and down, but it doesn't go far. After a breakout, the market has room to run. There are no recent levels in the way. That's when you can get paid for being right. But you have to be careful. Not every breakout is real. Some are just brief pushes that fade. The difference is in how price behaves after the break. Does it pull back and hold above the old resistance? Does volume support the move? Those clues tell you whether the balance of power has really shifted or if it's just a temporary flare. Breakouts also reveal where the crowd is positioned. If a lot of traders are short near resistance, a break above it will force them to buy. That buying adds to the move. If a lot of traders are long near support, a break below it will force them to sell. That selling adds to the move. The more crowded one side was before the break, the more powerful the move tends to be after. This is why experienced traders pay attention to how long a market has been stuck. The longer the range, the more positions get built up inside it. The more positions there are, the more fuel there is for the breakout. A short, narrow range might produce a small move. A long, tight range can produce a big one. There's also a lesson here about patience. If you try to trade every little wiggle inside a range, you burn energy and capital. If you wait for the breakout, you're waiting for the moment when the market actually shows its hand. That doesn't mean you'll catch every move, but it means the ones you do catch have a better chance of being meaningful. Breakouts also teach you about trend. A single breakout doesn't make a trend, but it's often the first step. Once price moves into new territory, it creates new support and resistance levels. If it keeps breaking higher levels, you get an uptrend. If it keeps breaking lower levels, you get a downtrend. The balance of power keeps shifting in favor of the dominant side. This ties directly into building wealth as a trader. Big gains don't usually come from small, choppy moves. They come from catching trends early and staying with them. Breakouts are often the door into those trends. If you can recognize when a real shift is happening and position yourself accordingly, you give yourself a chance to ride something that can grow over time.